Hello everybody, welcome to the 41st episode of me learning how to trade using Forex. So in the last video we went through the Forex market structure. We just basically read through all of this, the Forex ladder, the retail traders, the medium-sized banks, the major banks, them trading between each other, la-di-da-di-da, and now we're on to the Forex market players. So yeah, let's get started. Forex market players. Now that you know the overall structure of the Forex market, let's delve in a little deeper to find out who exactly these people on the ladder are. It is essential for you to understand the nature of the spot Forex market and who are the main Forex market players. Let's learn about the main players on the Forex market and the big shot banks, the little guys at home in their pajamas. Until the late 1990s, only the big boys could play this game. The initial requirement was that you could trade only if you had about 10 to 50 million bucks to start with. Chump change, right? Forex was originally intended to be used by bankers and large institutions, and not by us little folks. However, because of the rise of the internet, online Forex brokers are now able to offer trading accounts to retail traders like us. Without further ado, here are the major Forex market players. The super banks. So, Forex market players. Super banks. When it comes to Forex trading, commercial banks and financial institutions are the movers and shakers. Since the Forex spot market is decentralized, it is the largest banks in the world that determine the exchange rates. In the world, which determines the exchange rates. They're responsible for most of the daily trading volume, and they make their money by acting as the market makers. This means that they're constantly buying and selling currencies, pocketing the difference between the bid and ask prices. It's a high stakes game, but these banks have the deep pockets and expertise to play it. These large banks, collectively known as the interbank or interdealer market, take on the ridiculous amount of Forex transactions each day for both their customers and themselves. They are known as flow monsters. For these flow monsters, the name of the game is volume and capturing their share of the trading volume of currencies. The name of the game is volume and capturing their share of the trading flow of currencies. A couple of these flow monsters include Citi, JP Morgan, UBS, Barclays, Deutsche Bank, Goldman Sachs, HSBC, and Bank of America. Decade changes in 2 years. Market shares ranking 2006 to 2016. Number equals rank. Barclays, red 5, 3, 3, 4, 6, 2016. JP Morgan, Citi, JP Morgan has been on the rise. Bank of America. Interbank market, largest banks in the world, which are collectively known as the interbank market. Electronic liquidity providers. Electronic liquidity providers. Electronic liquidity providers are specialized firms that have grown to be major players in the foreign exchange market by using advanced technology and trading algorithms to provide liquidity to market participants. Provides liquidity to market participants. Examples of ELPs are Citadel Securities, Flow Traders, HC Tech, Jump Trading, Virtual Financial, and XTX markets. They operate as intermediaries between buyers and sellers in the currency market. constantly quoting bid and ask prices for various currency pairs. Operates as intermediary between players and between buyers and sellers, not players, Jesus, between buyers and sellers. Quoting bid and ask prices. Intermediary participants. Their presence helps to ensure that market participants can find counterparties for their trades, allowing for faster execution and reducing potential impact of market volatility. As they ensure that market participants can find counterparties for their trades. What have I written for super banks? I feel like I haven't written enough for it. Make their money back as market makers. Exchange rates. Which largest banks in the world which determines the exchange rates. It is the largest banks in the world that determine the exchange rates. In the world which determines the exchange rates. Responsible for most of the daily trading volume and make money by constantly buying and selling currencies by pocketing the difference when constantly buying and selling currency. Responsible for most of the daily trading volume and make money by pocketing the difference between constantly pocketing the difference when constantly between is it between or when between buying and selling currencies, collectively known as interbank markets. Okay, that's good. Okay, flow monsters. Redonkulously, okay. Name of the game is volume, and capturing their share of trading. So they're going for volume, so doing as much as they can, basically. Okay. Large commercial companies. Large commercial companies. Let's see. Companies take part in the foreign exchange market for the purpose of doing business. For instance, Apple must first exchange its US dollars for the Japanese yen when purchasing electronic parts from Japan for its products. Since the volume they trade is much smaller than those in the interbank markets, this type of market player typically deals with commercial banks for their transactions. Mergers and acquisitions between large companies can also create currency exchange rate fluctuations. In international cross-border mergers and acquisitions, a lot of currency conversion happened that could move prices around. Corporations might not be the most glamorous participant in the Forex market, but they're essential players nonetheless. Companies that do business internationally need to buy and sell currencies to pay for goods and services, hedge their exposure to currency fluctuations and manage their cash flow. They may not be trading for profit, but their currency needs can still have a significant impact on the market. Large commercial companies. Trading volume is much smaller than interbank market. So typically deals with commercial banks for their transactions. Government and central banks. Governments and central banks, such as the European Central Bank and the Bank of England and the Federal Reserve, are regularly involved in the Forex market too. Wait, so HSBC is like bigger than the Bank of England? HSBC, oh, of course it would be. HSBC is like all over the place, isn't it? Barclays. Just like companies, national governments participate in the Forex market for their operations, international trade payments, and handling their foreign exchange reserves. Central banks are like the puppet masters of the Forex market. These big kahunas are responsible for implementing monetary policies that can move currency values. Central banks. Responsible for implementing monetary policies which can move currency values. Central banks responsible for implementing monetary policies which can move currency values. They're the ones who adjust interest rates and control the money supply. They also adjust interest rates and control the money supply. By doing this, they can affect currency valuation, which affects the currency valuation. There are also instances when central banks intervene, either directly or verbally, in the Forex market when they want to realign exchange rates. Sometimes central banks think that their currency is priced too high or low, so they start massively sell-buy operations to alter exchange rates. When central banks make a move, everyone pays attention. The speculators. Currency speculation is the act of buying and holding foreign currency in the hopes of selling that currency at a high exchange rate in the future. This is in contrast to those who buy currencies to finance a foreign investment or to pay for an imported product or services. In it to win it. This is probably the mantra of the speculators. Speculation in the forex market involves the buying and selling of currencies with a view of making a profit. Speculators are focused on price fluctuations. Focused on price as they use the market to make a profit. It is called speculation because of the uncertainty involved, since no one can know for sure whether a currency pair's price will go up or down. Traders assess the likelihood of either scenario before placing a trade. Comprising close to 90% of all trading volume, speculators as forex market players come in all shapes and sizes. Some have fat pockets, some roll thin, but all of them engage in the forex simply to make buckets load of cash. For this lesson, let's narrow down speculators in two buckets. Hedge funds, retail traders. Hedge funds and prop firms are smart money. Hedge funds and prop firms are known as smart money in the forex market. These savvy traders use advanced strategies and advanced analytic tools to make educated bets on currency movements. They're not afraid to take risks, and they often employ leverage to make their bets even bigger. Retail traders, little folks with big dreams. Last but not least, we have retail traders, the little guys and gals with big dreams. These are individual traders who trade currency from their home computers, smartphones or tablets. They may not have the deep pockets or sophisticated tools of the big players, but they are a growing force in the forex market, thanks to the proliferation of online trading platforms and educational resources. Retail traders come in all shapes and sizes, from the casual hobbyist who dabbles in forex trading for fun, to the aspiring professional who dreams of quitting their day job to trade full time. They may not move the market like the big players, but they're an essential part of the forex ecosystem. The forex market is a melting pot of participants, each with its own goals, strategies and resources. From the powerful central banks to the humble retail traders, every player has a role to play in the global currency market. Yeah, let's do that. Know your retail forex history. Once upon a time, foreign exchange trading was a stuffy affair, reserved for professionals and institutional investors. But then a wave of technological advancements swept in, and today the market is globally accessible to individual traders. Let's take a light-hearted tour through the history of retail FX trading and see how we got from pocket protectors to mobile apps and beyond. The early days, when FX trading was a members-only club. Retail FX trading emerged in the groovy 1970s after the Bretton Woods system, which has pegged global currencies to the US dollar, was dismantled in 1971. The resulting shift to a floating exchange rate system paved the way for increased currency speculation and the birth of the modern foreign exchange markets. Unfortunately, back then, FX trading was like an exclusive club, with trading accessible only to banks, hedge funds and large corporations. Individual traders lacked access to the necessary resources and technology to participate in the market. In other words, too small and too poor. The 1990s entered the internet and a new era of retail FX trading. Once the 1990s came along, thanks to the computer nerds and the booming growth of the internet, cheers to you, Mr. Al Gore, banks began creating their own trading platforms. These platforms were designed to stream live quotes to their clients so that they could instantly execute trades themselves. Meanwhile, some smart business-minded marketing machines introduced internet-based trading platforms for individual traders. Known as retail forex brokers, these entities made it easy for individuals to trade by allowing smaller trade sizes. Unlike in the interbank market where the standard trade size is 1 million units or more, retail brokers allowed individuals to trade position sizes as little of as little as 1,000 units. No longer was the market a members-only club. Individual traders were now invited to the party. The 1990s witnessed a significant turning point for retail FX trading, as the rapid development of the internet and personal computers enabled individual traders to access the currency markets. As internet speed increased, online trading platforms popped up like mushrooms after a mushroom, providing retail traders with user-friendly interfaces and access to market data, news and analysis. Jesus. The explosion of online forex brokers and trading platforms. The early 2000s saw an explosion of online brokers, each eager to offer retail FX trading services. They wooed individual traders with the promises of trading platforms, educational resources, and access to leverage, because who doesn't love controlling larger positions with a smaller investment? The increased competition among brokers led to tighter spreads, lower trading costs, and an expansion of trading products beyond major currency pairs. Today, retail FX traders have access to a wide range of trading platforms, including MetaTrader 4 and 5, CTrader, and various proprietary platforms developed by individual brokers. They even offer mobile apps so you can trade on your smartphone. There's something for everyone, whether you're a charting connoisseur, a technical indicator aficionado, or an automated trading enthusiast. Regulatory evolution and the protection of retail traders. The growth of retail FX trading attracted the attention of financial regulators who sought to protect individual traders from shady forex brokers and maintain market integrity. The retail FX market was super shady back then. It was the Wild West. They introduced strict rules and requirements for FX brokers, making sure they had enough capital, managed risk properly, and treated customers fairly. It was like having a stern but loving parent watching over the market. Prominent regulatory agencies in the retail FX industry include the US Commodity Futures Trading Commission, the UK Financial Conduct Authority, the Australian Securities Investment Commission, and the European Securities and Markets Authority. Futures Trading Commission. These regulators have implemented measures such as leverage restrictions, negative balance protection, and mandatory segregation of customer funds to protect retail traders. Summary. The history of retail FX trading is a colourful and exciting tale, filled with technological leaps, increasing accessibility, and ever-watchful regulatory guardians. From its humble beginnings in the 1970s to the present day, retail FX trading has transformed into a global phenomenon, offering individual traders the opportunity to participate in the world's largest and most liquid financial markets. As technology continues to advance and regulations adapt, the future of retail FX trading promises to be even more fun and accessible for traders around the world. Okay, quiz time. Who trades Forex? Do you know who the major players are in the Forex market? Of the following answers, which is the largest disadvantage going through a centralized exchange? Price manipulation. Correct. In a centralized market, there is only one entity and one specialist that controls prices. All trades must go through a specialist. Because of this, prices can easily be altered to benefit the specialist and not the traders. Which entity sits at the very top of the Forex ladder? The World Bank, isn't it? Wait, what? At the very top of the Forex market ladder is the interbank market, composed of the largest banks in the world and some smaller banks. The participants of this market trade directly with each other or electronically through the electronic brokering services or the routers dealing 3000 spot matching. What is an example of a decentralized exchange? The Forex market. Unlike in the trading stocks or futures, you don't need to go through a centralized exchange like the New York Stock Exchange with just one price. In the Forex market, there is no single price that for a given currency at any time, which means quotes from different currencies dealers vary. The collection of the world's superbanks, which determines exchange rates, is also known as what? The interbank market. Correct, since the Forex spot market is decentralized, it is the largest banks in the world that determine exchange rates. These large banks, collectively known as the interbank market, take on a redonkulous amount of Forex transactions each day for both their customers and themselves. Well, if it's decentralized, that means there's no top. But the largest banks in the world determines the exchange rate, so they're basically top. Huh? Which central bank policy action tends to have the biggest effect on exchange rates? Which central bank policy tends to have the biggest change in FX rates? Controlling supply of money, buying large ridiculous reserves, adjust the interest rates. Central banks affect the forex market when they adjust interest rates to control inflation. By doing this, they can affect currency valuation. There are also instances when the central banks intervene, either directly or verbally, in the forex market when they want to realign exchange rates. Which market players account for roughly 90% of trading volume? Speculators. Comprising close to 90% of all trading volume, speculators as forex market players come in all shapes and sizes. Some have fat pockets, some roll thin, but all of them engage in the forex simply to make bucketloads of cash. Which global agreement set the exchange rate of all currencies against gold? Which global agreement set the exchange rate of all currencies against gold? Is it this? Known as a Bretton Woods system, the agreement set the exchange rate of all currencies against gold. This stabilized exchange rates for a while, but as the major economies of the world started to change and grow at different speeds, the rules of the system soon become obsolete and limiting. In a free-floating system, what determines exchange rates? In a free-floating, what's a free-floating system? Supply and demand, isn't it? In 1971, the Bretton Woods Agreement was abolished and replaced by a different currency valuation system. With the United States in the pilot seat, the currency market evolved into a free-floating one, where exchange rates were determined by supply and demand. Which of the following is an advantage of retail forex brokers over the interbank market? Small account sizes available. Some smart business-minded marketing machines introduced internet-based trading platforms for individual traders, known as retail forex brokers. These entities made it easy for individuals to trade by allowing smaller trade sizes. Unlike the interbank market, where the standard trade size is 1 million units, retail brokers allowed individuals to trade as little as 1,000 units. Which among the three is not a type of broker? Which among the three is not a type of broker? Market maker is the interbanks, isn't it? That's what they call them, market makers. Trade maker, I guess ECN. Oh no, brokers basically come in two forms. Market makers, as their name suggests, make or set their own bid and ask prices themselves, and electronic communication systems, who use the best bid and ask prices available to them from different institutions on the interbank markets. Brokers. Oh, they're brokers then. Oh, I thought brokers is like the people who allows you to trade with small account sizes. What they call forex retail brokers, retail forex brokers or something. Oh, never mind. So. Okay, market makers and electronic communication network. Okay, what does ECN stand for? Okay, electronic communications network. We just read that. A type of retail forex broker, electronic communications network uses the best bid and ask prices available to them from different institutions on the interbank market. Cool. Next lesson. Why trade Forex? Advantages of Forex trading. There are many benefits and advantages of trading Forex. Here are just a few reasons why so many people are choosing this market. No commission, no clearing fees, no exchange fees, no government fees, no brokerage fees. Most retail Forex brokers are compensated for their services through something called the spread. No fixed lot size. In the future markets, a lot where in the future markets, lot of contract sizes are determined by the exchanges. For example, a standard size contract for silver futures is 5,000 ounces. In Forex, you can trade smaller lot sizes or position size. This allows traders to open trades as little as 1,000 units. Low transaction costs. The retail transaction cost, the bid-ask spread, is typically less than 0.1% under normal market conditions. For larger transactions, the spread could be as low as 0.07%. Of course, this depends on your leverage, and all that will be explained later. A 24-hour market. There is no waiting for the opening bell. From the Monday morning opening in Australia to the Friday afternoon close in New York, the Forex market never sleeps. This is awesome for those who want to trade on a part-time basis because you can choose when you want to trade: morning, noon, night, during breakfast, or in your sleep. No one can corner the market. The FX market is sufficiently liquid that significant manipulation by any single entity is all but impossible during active trading hours for the major currencies. The foreign exchange market is so huge that has so many participants that no single entity, not even a central bank or the mighty Chuck Norris himself, can control the market price for an extended period of time. So they can do it for a short period of time, but not like a long period of time. Leverage. In Forex trading, a small deposit controller can control a much larger total contract value. Leverage gives the trader the ability to make nice profits and at the same time keep risk capital to a minimum. For example, a Forex broker may offer 50 to 1 leverage, which means that a $50 margin deposit would enable traders to buy or sell $2,500 worth of currencies. Similarly, with $500, one could trade with $25,000 and so on. Whilst this is all gravy, let's remember that leverage is a double-edged sword. Without proper risk management, this high degree of leverage can lead to large losses as well as gains. Deep liquidity. Because the Forex market is so enormous, it is also extremely liquid. This is an advantage because it means that under normal market conditions, with a click of a mouse, you can instantaneously buy and sell at will. You are never stuck in a trade. You can even set your online trading platform to automatically close your position once your desired profit level, a limit order, has been reached, and or close the trade if the trade is going against you, a stop loss order. Low barriers to entry. You would think that getting started as a currency trader would cost a ton of money. The fact is, when compared to trading stocks, options, or futures, it doesn't. Online Forex brokers offer mini and micro trading accounts, some with a minimum account deposit of $50. We are not saying that you should open an account with bare minimum. But it does make Forex trading much more accessible to the average individual who doesn't have a lot of startup trading capital. Free stuff everywhere. Most online Forex brokers offer demo accounts to practice trading and building your skills, along with real-time Forex news and charting services. And guess what? They're all free. Demo accounts are very valuable resources for those who are financially hampered and would like to hone their trading skills with play money before opening a live trading account and risking real money. Now that you know the advantages of the Forex market, see how it compares with the stock market. Okay. Why trade Forex? Forex versus stocks. There are approximately 2,400 plus stocks listed on the New York Stock Exchange. Another 3,900 are listed on the Nasdaq. Which one will you trade? Got the time to stay on top of so many companies? With Forex, there are dozens of currencies traded, but the majority of market players trade the 7 major pairs. Aren't 7 major pairs much easier to keep an eye on than thousands of stocks? Look at Mr. Forex, he's so confident and sexy. Mr. Stocks has no chance. And that's just one of the many advantages of the Forex market over the stock markets. Here are a few more. 24-hour market. The stock market is limited to an exchange's opening hours. For example, in the US, most stock exchanges open at 9:30 AM Eastern Time and close at 4 PM Eastern Time. The Forex market is a seamless 24-hour market. Most brokers are open from Sunday at 5 PM Eastern Time until Friday at 5 PM Eastern Time, with customer service usually available 24/7. With the ability to trade during the US, Asian and European market hours, you can customize your own trading schedule. Minimal or no commissions. Thanks to Robinhood, a lot of online stockbrokers now offer 0 commissions. This is now less of a factor. Most Forex brokers charge no commissions or additional transaction fees to trade currencies online or over the phone. Combined with the tight, consistent and fully transparent spreads, Forex trading costs are lower than those of any other markets. Most brokers are compensated for the services through the bid-ask spread. High trading volume and liquidity. The Forex market sees an average daily turnover of just $6.6 trillion. The stock market sees a fraction of this. Short selling without an uptick. Unlike the equity markets, there is no restriction on short selling in the currency market. Trading opportunities exist in the currency market regardless of whether a trader is long or short, or whichever way the market is moving. Since currency trading always involves buying one currency and selling another, there is no directional bias to the market, so you can always have the equal access to trade in a rising or falling market. Minimal market manipulation. How many times have you heard that Fund A was selling X or buying Z? The stock market is very susceptible to large fund buying and selling. With currency trading, the massive size of the Forex market makes the likelihood of any one fund or bank controlling a particular currency very small. The FX market is sufficiently liquid that significant manipulation by any single entity is all but impossible during active trading hours for the major currencies. Banks, hedge funds, governments, retail currency conversion houses, and large net worth individuals are just some of the participants in the spot currency markets where the liquidity is unprecedented. Analysts and brokerage firms are less likely to influence the market. Have you watched TV lately? Heard about a certain internet stock and an analyst of a prestigious brokerage firm accused of keeping its recommendations, such as buy when the stock was rapidly declining. It is the nature of these relationships. No matter what the government does to step in and discourage this type of activity, we have not heard the last of it. IPOs and SPACs are big businesses for both the companies going public and the brokerage houses. Relationships are mutually beneficial, and analysts work for the brokerage houses that need the companies as the clients. That catch-22 will never disappear. Foreign exchange as a prime market generates billions in revenues for the world's banks and is a necessity of the global markets. Analysts in foreign exchange have very little effect on exchange rates, they just analyze the Forex market. So, in a summary, advantages: 24-hour trading, Forex yes, stocks no, minimal no commission, Forex yes, stocks maybe, liquidity, Forex huge, stocks meh, short selling without an uptick, Forex yes, stocks no, no market manipulation, Forex depends, stocks no. So it still depends. In a battle between Forex versus stocks, it looks like the scorecard between Mr. Forex and Mr. Stocks shows a strong victory by Mr. Forex. Will it go for 2 over Mr. Futures? Why trade Forex? Forex versus futures. It's not just the stock market. The Forex market also boasts a bunch of advantages over the futures market, similar to its advantage over stocks. But wait, there's more, so much more. Liquidity. In the Forex market, $6.6 trillion is traded daily, making it the largest and most liquid markets in the world. This market can absorb trading volume, and transaction sizes that dwarf the capacity of any other markets. The futures market trades a puny 30 billion per day. 30 billion? Peanuts. The futures market can't compete with this relatively limited liquidity. The Forex market is always liquid, meaning positions can be liquidated and stop orders executed with little or no slippage, with exception to the extremely volatile market conditions. Mr. Futures, our shorts look cool. Okay. Remember, slippage, I think, here means that if you want to buy at one price, if slippage happens, then you might not be able to buy it at that price or any. So yeah, you might not be able to buy at that price anymore. So that's slippage, I think. 24-hour markets. At 5 p.m. Eastern Time Sunday, trading begins as markets open in Sydney. At 7 p.m. Eastern Time, the Tokyo market opens, followed by London at 3 a.m. Eastern Time. And finally, New York opens at 8 a.m. Eastern Time and closes at 4 p.m. Eastern Time. Before New York trading closes, the Sydney market is back open. It's a 24-hour seamless market. As a trader, this allows you to react to favorable or unfavorable news by trading immediately. If important data comes in from the United Kingdom or Japan whilst the US futures market is closed, the next day's opening could be a wild ride. Overnight markets and futures contracts do exist, and while liquidity is improving, they are still thinly traded relative to the spot forex markets. Minimal or no commissions. With electronic communications brokers becoming more popular and prevalent over the past couple of years, there is a chance that the broker may require you to pay commissions. But really, the commission fees are peanuts compared to what paid in the future markets. The competition among spot forex traders is so fierce that you will most likely get the best quote and very low transaction costs. Price certainty. When trading forex, you get rapid execution price certainty under normal market conditions. In contrast, the futures and equities market do not offer price certainty or instant trade execution. Even with the advent of electronic trading and limited guarantees of execution speed, the prices for fills for futures and equities and the market orders are far from certain. The prices quoted by brokers often represent the last trade, not necessarily the price for which the contract will be filled. Oh, right, okay. So, note for stocks. Price quoted by brokers represent the last trade, not necessarily the price for which the contract will be filled. Guaranteed limited risk. Traders must have position limits for the purpose of risk management. This number is set relative to the money in a trader's accounts. Risk is minimized in the spot forex market because of the online capabilities of the trading platform will automatically generate a margin call if the required margin amount exceeds the available trading capital in your amount. During normal market conditions, all open positions will be closed immediately. During the fast market conditions, your position could be closed beyond your stop loss level. In the futures market, your position may be liquidated at a loss bigger than what you had in your account, and you will be liable for any resulting deficit in the account. That sucks. Advantages: 24-hour trading, Forex yes, futures no, minimal or no commission, Forex yes, futures no. Advantages: up to 500 to 1 leverage, Forex yes, futures no. Price certainty, Forex yes, futures no. Advantages: guaranteed limited risk, future Forex yes, futures no. Judging by the Forex versus future scoreboard, Mr. Forex looks unbeatable. Now meet the winners who trade the Forex market. Why trade Forex? Do you know why you're going into Forex instead of another business venture? Yes, I do. How many hours a day is the Forex market open? 24 hours. Correct. The Forex market is a seamless 24-hour market. There is no waiting for the opening bell. From Monday morning opening in Australia to the afternoon close in New York, the Forex market never sleeps. Which of the following is true about the futures markets? Overnight markets and futures contract do exist. That's the one. Overnight market and futures contract do exist, and while liquidity is improving, they are still thinly traded relative to the spot forex market. What is the term used to describe the ability to control contract sizes much larger than your deposit? Leverage. In forex trading, a small deposit can control a much larger total contract value. Leverage gives the trader the ability to make nice profits and at the same time keep risk capital to a minimum. But remember, leverage is a double-edged sword, so you could magnify your profits, but you could also magnify your losses as well. The stock market is just as liquid as the forex market. Oh hell no, they're trillions of dollars apart. The forex market sees an average daily turnover of 6.6 trillion. The forex market sees an average daily turnover of 6.6 trillion. The stock market sees a fraction of this. Which of the following is the disadvantage of the stock market? Disadvantages: strong influence from analysts and brokers. Heard about a certain internet stock and an analyst of a prestigious brokerage firm accused of keeping its recommendations such as buy when the stock was rapidly declining. It is the nature of these relationships. No matter what the government does to step in and discourage this type of activity, we have not heard the last of it. Which market has more liquidity? The Forex market. Forex. In the Forex market, 5.3 trillion is traded daily. I thought it was 6.6 trillion. Okay. Making it the largest and most liquid market in the world. This market can absorb trading volume and transaction sizes that dwarf the capacity of any other markets. The futures market trades at puny 30 billion per day. In the futures market, your position may be liquidated at a loss bigger than what you had in your account, and you'll be liable for any resulting deficit in that account. True. In the futures market, your position may be liquidated at a loss bigger than... Okay, that's just repeating what it says in the question above. What type of account do Forex brokers offer to let you practice trading and building your skills with real-time Forex news and charting services? Demo accounts. Demo accounts are very valuable resources for those who are financially hampered and would like to hone their trading skills with play money before opening a live trading account and risking real money. The following are advantages of trading Forex except guaranteed wins. Expertise in using different trading tools will give you better chances of winning trades, but this will not guarantee that you will always win. True or false? It's impossible to get started in currency trading without minimum account deposit of at least 1,000. False. Online Forex brokers offer mini and micro account trading accounts, some with a minimum account deposit of $50. We are not saying you should open an account with a bare minimum, but it does make Forex trading much more accessible. 10 out of 10. Cool. Hello. Right, okay, so I think I'm going to leave this video here, guys. Thank you guys for watching. In the next video we're going to be carry on with what is margin trading. So yeah, see you then. Bye.